this video, let's have a look at question 24 of chapter 4. On January the 1st, Peterson Corporation acquired 80% of the 100,000 outstanding voting shares of Serrano Inc. in exchange for $31.25 per share. The remaining 20% of Serrano's share continued to trade for $30, both before and after Peterson's acquisition. On January the 1st, which is the acquisition date, Serrano books and fair value were as follows. Okay, so I have a table shows the book value and fair value of the subsidiary company, and you can see that there are a few accounts, especially the asset account, that have different fair value from book value. Okay, in addition, Peterson assigned $600,000 value to certain unpatented technology recently developed by Serrano. These technologies were estimated to have a 3-year remaining life, so which means that there's another asset not recorded on the book yet. During the year, Serrano declared $30,000 dividends for its shareholders. The company reported the following revenue expense for their separate operation for the year ending December 31st. Okay, so here we have the Peterson and Serrano's revenue and expense. First, before we go to the questions, let's prepare the work on the step 1. So that's what we normally did in chapter 23. That in chapter 23 we will have a step 1. So step 1 is to prepare the allocation schedule of the subsidiary company's fair value. Okay, so let's use this as practice of this first step. In step 1, the first is what is total consideration paid. And in this question, in chapter 4, the parent company does not have 100% control of the subsidiary company, which means that it's only controlled part of it, and there are some non-controlling interests as well. So here, Peterson acquired 80% of the 100,000 outstanding voting share in exchange for $31.25. So this tells us how much they paid, or how much the parent company paid for the 80% control interest. So the 80% control interest cost them 80% of the total 100,000 of the outstanding share and times the trading price, $31.25, equals to $2.5 million. So this is total consideration transferred by the parent company to the subsidiary company, and there is additional of the remaining 20% non-controlling interest. And for them, so that's 20% of the total outstanding share and times the trading price of this 20% share. They have different price. You see that here, the parent company of Peterson paid a higher price to get the controlling interest of Serrano. And sometimes this would happen is because that's like an incentive for the current shareholder to sell their stock to Peterson. So in this transaction, there is a premium, or control premium. Anyway, okay, so let's go back here. So the total fair value assessed. So the total fair value here. Now the assess equals to the total of the total fair value of the controlling interest and plus the fair value of the non-controlling interest equals to $3.1 million. Alright, so now I get the total fair value that the parent company assessed about the value of the subsidiary company, and then next is what is total book value acquired. So book value acquired, what we can do is that we can use the balance of the equity account to get the total amount. So it equals to 50,000 plus 500,000 and plus 740,000 equals to 1,290,000. So this is total fair value acquired, and then the excess of fair value over book value equals to 1,810,000. And the next step is to allocate the excess amount to those accounts with different fair value from book value. Okay, allocation. And then we need to go back to this book value and fair value table and look at those assets and liabilities, which one have different value from book value. And so you can see that the buildings and equipment, trademark, patent technology, they all have a different fair value from book value. Also, there is the unpatented technology. It also has unrecognized market value that should be considered. Okay, so which means that we're going to have full account currently have different fair value from book value. Come back here. The first is building and equipment. Building and equipment is overvalued by 250,000 and equals to its fair value minus its book value, and the difference is a negative 250,000. It's overvalued. And the remaining life of building and equipment is 5 years, which means that the annual excess annual depreciation would be amortization be negative 50,000. Next is the trademarks. So trademarks is like a trademark value. So trademarks, if we use fair value minus its book value, it's undervalued by 200,000. So 200,000, and it has 10-year remaining life. So each year there is a 20,000 excess amortization. Next one is the patent technology, and it's undervalued by 1,060,000, has 4-year remaining life, and every year there is a 265,000 annual amortization. And the last one is the unpatented tech, and it's annual value by 600,000, has 3-year remaining life. So each year there's going to be 200,000 excess amortization expense. Okay, so that's the full account that we can identify have different fair value from book value. And then if we use the total excess amount minus those difference, and we see that there's a remaining amount that will be allocated to goodwill is 200,000. We normally do not amortize goodwill. Okay, so to complete this schedule, we know that there is going to be 435,000 total excess amortization the company, as parent company, need to consider when they prepare the consolidation entries. Okay, so I'm going to use the following videos to complete other questions. Okay, requirement 1. A. What amount should Patterson recognize as the total value of the acquisition in its January 1st consolidated balance sheet? So the total value of the acquisition is calculated here, 3.1 million. So this is the total assess fair value, including both the controlling interest and non-controlling interest. 3.1 million. What valuation principle should Patterson use to report each of Serrano's identifiable assets and liabilities in its January 1st consolidated balance sheet? We use their fair value. For years subsequent to acquisition, how will Serrano identifiable assets and liabilities be valued in Patterson's consolidated financial statement? So every year we're going to use its book value and plus those fair value adjustment. So what do we mean fair value adjustment? They are the difference between the fair value and the book value. That's the amount here. And then minus accumulated excess annual amortization. And as to those excess annual amortization, they are the amount here. Okay, so that's for question C. How much goodwill resulted from Patterson's acquisition of Serrano? So the amount of goodwill is 200,000. Next one. What is the consolidated net income for the year and what amount are allocated to the controlling and non-controlling interest? So first, I paste the parent and subsidiary company revenue expense. And first, let's calculate what their reported net income is going to be. So for Patterson, the net income would be its revenue minus its expense. It equals to 1,250,000. Well, for Serrano, its reported net income will be 800,000. Okay. As to their consolidated net income, we do not consolidate their net income directly because we need to have some adjustment here. So first, let's calculate what their consolidated revenue. So their consolidated revenue equal to the Patterson revenue plus Serrano's revenue. That's 4.4 million. As to their expense, it's going to equal to their reported expense and plus the excess annual amortization. That's 435,000. So that amount is the amount here, just calculated. And then we can get consolidated expense would be 2,785,000. And we use consolidated revenue minus consolidated expense, and the consolidated net income is 1,615,000. And second is how much of the consolidated net income will be allocated to non-controlling interest. So for non-controlling, it's going to get 20% of the adjusted income from Serrano. That's 800,000 minus 435,000, and it's going to equal to 73,000. So 73,000 will be allocated to non-controlling interest, and if we allocate 73,000 to non-controlling interest, then the net income, okay, so this is the net income to non-controlling interest, and then net income to controlling interest will be 1,615,000 minus 73,000, that equal to 1,542,000 will be allocated to controlling interest. Alright, so I'm going to use another video to show the answer to question F and G. F. What is the non-controlling interest amount reported in the December 31st consolidated balance sheet? The way we calculate non-controlling interest amount of balance is similar to the way we calculate investment in subsidiary account balance. It should equal to the beginning balance of the non-controlling interest, which is 600,000. So this is the amount of non-controlling interest on the acquisition day, and plus net income allocated to non-controlling interest, which is 73,000, and then minus the dividend paid to non-controlling interest equals to 20% of the total dividend paid. And then the ending balance will equal to 667,000. Next one, assume instead that based on its share price, Serrano's January 1st total fair value was assessed at $2,250,000. How would the reported amount for Serrano's net asset change on Patterson's acquisition day consolidated balance sheet? So this change of assessed fair value is not going to have an impact on subsidiary companies' net asset, identifiable net asset amount. In other words, look at here. In other words, in this, if that's the case, then all the account here should also are still going to be recognized at its fair value. But the question is whether there is a goodwill in this case. So let's have a look. Well, if the assessed fair value is, okay, so if the assessed equals to 2,250,000, and the next we need to calculate what is the relative fair value of the identifiable net assets of the subsidiary company. That's should equal, the way we calculate that should equal to the fair value of its total asset here minus the fair value of its total liabilities, and plus this 600,000 unrecorded unpatented technology, and that amount equals to 2.9 million. Okay, so next let's calculate what is the difference between these two amounts. You see, we can easily notice that the assessed amount is smaller than the relative amount acquired from the subsidiary company, and then which means that there is a gain in this transaction. So there is a gain on bargaining purchase. And equals to 650,000, and because the assessed amount is smaller than the relative amount acquired, and then if we use assessed amount minus the relative amount, we got negative number, and that's a gain. Well, if the assessed amount is larger than the relative amount, then we get a positive result, and then that will goes to the goodwill.